I think in our last episode, we had a very interesting discussion about portfolio sizing. And as I recall, our personal portfolios ranged from 11 shares up to around 30. So quite a lot of variation there. And that's probably a useful reminder that there is never a single right answer in investing. What's right is what works for you and what you can stick with. And as a kind of following on from this, really, I think Mark, one of your followers on Twitter, asked if we could share our views on asset allocation as well. So I think the question here is whether we invest in other assets apart from UK shares, so perhaps property, bonds, crypto or gold, and how much of our portfolios we allocate to these other asset classes.
Hello, and welcome to the Investors Roundtable, a four-way discussion where Roland Head, Mark Simpson, Bruce Packard, and Maynard Paton talk about their shares, portfolios, and the markets. Roland seeks reliable dividends, Mark prefers deep value, Bruce likes quality compounders, while I look for owner management. This time we cover shipping and investment group Ocean Wilson, disinfectant specialist Tristel, and software developer Arcontech. But before we get started, I would like to talk a little about the future of this podcast, and indeed the future of our sister podcasts, the Value Trap podcast with Mark and Bruce, and the Private Investors podcast with Roland and myself. The feedback and comments we have received about these podcasts have been very encouraging, and all four of us are really keen to continue recording our investing conversations. And we all hope you have enjoyed our discussions and want to keep listening as well. But as you might imagine, these podcasts do involve a fair amount of time and effort, and they do require some skilled podcast editing. So we have had to make a decision. Do we continue with our podcasts or not? Well, I'm happy to say we are continuing. But, and here's the important news, the podcast will no longer be free. From the 1st of August 2023, we will introduce a modest monthly charge to listen to the Investors Roundtable podcast, the Value Trap podcast, and the Private Investors podcast. The charge is £12.50 a month, and your support covers our costs and helps us produce high-quality investing conversations. Now, we did consider taking adverts and sponsors, but neither Roland, Mark, Bruce, or myself like podcasts full of adverts, and none of us really wanted to pander to sponsors either. Bottom line is, we just want to be able to speak freely on our podcasts and only focus on you, the listener, rather than think about pleasing advertisers and sponsors as well. Now, I know full well private investors never like to pay for anything, which is fair enough. There are plenty of free podcasts out there for you to listen to, and there's no hard feelings if you do not wish to pay. But if you do want to listen to four experienced private investors talking about shares, then please do consider a subscription. And if you do join us, you can easily submit investing questions for the four of us to discuss in a future podcast. Our podcast will remain free until the 1st of August, but if you subscribe before then, you can enjoy our podcast for just £10 a month. Our podcasts after the 1st of August will still be available on all major platforms such as Apple, Google, and Spotify, and connecting to our subscriber-only feed can be done at a click of a button. Just visit pipod.co.uk, which is pipod.co.uk, to find out more, and there's a link in the show notes as well. We all hope you can join us, and if you do, you'll get to listen to real investors with real money talking about their own shares and portfolios, and all trying to find their next great investment. And if you do join us before the 1st of August, you pay £10 a month instead of the normal £12.50. That website link again, pipod.co.uk, and I hope you'll join us there. Now let's get started with Ocean Wilson, Tristel, and Arcontech.
Bruce, you own shares in Ocean Wilson's. Can you tell us why you bought the shares?
I slightly regretted choosing this one after I realized that it's quite a complicated business, quite a complicated investment case to explain to people, because effectively it's two businesses. It is a Brazilian port in Salvador that is quoted on the Brazilian Stock Exchange, and it's also a portfolio of hedge funds. And I bought into this a few years ago because it was at a discount to NAV. Now, the stake of the Wilson Sons, the Brazilian ports business, that's 57% of Wilson Sons. And if you look at the market cap of that business on the Mercado Stock Exchange in Brazil, it's 1.2 billion, which you then divide by 1.27 for the dollar-pound exchange rate and multiply by 0.57 to get the share that Ocean Wilson's own, and you get 540 million market cap. And that compares to a market cap in London of the whole business of 360 million. That's not even talking about the hedge funds, which are worth about 680 pence per share. This is a 50% discount to NAV. And management said a couple of weeks ago that they are going to look at restructuring and doing something in order to try and realize some value from shareholders.
Do they give any idea of what kind of realization that is? Are they planning on splitting it into two? Is that the idea?
It sounds like they're planning on splitting it in two. Now, the irony is, I think the valuable bit is the Brazilian ports business, because it's a ports business, whereas they also own these underperforming hedge funds that if they just bought 10 years ago, if they just bought an S&P 500 index tracker, then that would have increased in value by 3 times. The S&P's trebled over the last 10 years. But instead, they invested in all these high-cost fancy hedge funds that actually have only increased in value 20% over the last decade. So it's an extraordinary one, because it's management doing things that aren't really in their own best interests.
No, so it sounds like an interesting situation then. Mark, as a value investor, what's your view on Ocean Wilson's?
I followed this for a while, but I don't know a lot about the history. Where did they get the cash to invest in these hedge funds? Was that selling the other 43% of the ports business?
No, so the two directors, William Salmon and Townsend, can't remember his first name, they have a background in investment, and they are also involved in investment trust, which is called Hansa. And this has a long history of decades, going back, I think, 50 years. They ended up with this stake in Ocean Wilson's or Wilson Sons, buying into this more than 20 years ago.
Yeah, so they've always been investing. It's just they happen to have a successful investment in the ports business. Yeah, I'm just looking at the Q1 update, and they really do make a point of the net asset value. They point out all that you said, and they come up with a total net asset value of £17.81. And it sounds from your numbers that potentially the ports business has gone up in value again since then. So is the share price in response to this announcement. They're looking to realise value on this. Also noted that the company has not received any formal proposals from any third party with regard to a potential transaction involving Wilson Sons. So it sounds like they want to sell, but it hasn't been driven by somebody approaching them and saying, we're really interested in this ports business. Even then, a sort of competitive tender is often the way you're going to see the value out from this sort of thing. Yeah, I'd really want to know what they're going to do with the cash, because if they get paid cash and they invest it back into funds or just do nothing with it, then it's quite hard to argue that we should hold this for a 5% dividend yield with their slightly patchy history of actually putting the money to work. But if they said, oh, we're going to return the cash, then suddenly you're pretty much getting your investment back, and then you've got the rest of the funds. And I don't see why they wouldn't necessarily rationalize those and outvalue, particularly if those directors are still reasonable shareholders in the business.
So this is one of the problems, is that together they own more than 50% of the shares. So there's no angle for an activist to get involved, because these two guys are effectively in control of the company. But yes, I've actually been arguing for a long time that either they should return the cash, take their money out of the hedge funds, return it to shareholders who can probably invest it better than they can by buying an index tracker. Or if they're not going to do that, it's hard to see at what point they decide, oh, actually, we're not very good at this, and maybe buying all these high-cost hedge funds that don't actually outperform inflation is not the best idea.
I think the downside risk is that they don't get it away. They just continue with the strategy, and it looks like there's about maybe 15% premium in there for this corporate action that will disappear potentially if nothing happens. So
it's a 15% premium from where the price was a couple of months ago, but it's also still quite a large discount to the NAV. And when I say NAV, that's also the value that's quoted on the Brazilian stock exchange. It's not some made up NAV. That's maybe lots of venture capital investments that haven't been marked to market properly.
What do you think of the debt on the Brazilian stock exchange? Because could they, for example, just effectively float the rest of this? What sort of discount would they look at if they placed it just all into the stock market rather than to one strategic buyer?
I feel like that could be a possibility too, and just have a dual listing maybe as well in London and in Brazil, and get rid of this complexity of a hedge fund business and a ports business. To be fair to them, one of the things they say is that they've invested in absolute return hedge funds because they want the money available when everything goes wrong, when there's a big recession. That's exactly when the business might need money for investment. But actually, that didn't really work, because through the pandemic, everything sold off, and most hedge funds didn't do particularly well through the pandemic. They either were too slow to short things or they were too slow into the recovery. So the performance over the last few years hasn't been particularly good. And I feel like they've rather disproved their own hypothesis. And it also goes back to this bet that Warren Buffett took with Protein Partners just before the financial crisis, where he said, you guys can pick 5 hedge funds and I'll pick the S&P 500 index tracker and we'll see who does better over the next 10 years. And someone took him on to this bet and pretty quickly lost $1 million. And I feel like they've done exactly the same thing, that have a hard time struggling to understand that high cost absolute return hedge funds are maybe not a great investment.
So, Maynard, what's your view on Ocean Wilson's? Can you see any attractions?
I think the saving grace here is the strategic review. Now they're looking to sell, or at least explore to sell Wilson Sons. I think otherwise it's a value trap, with dominant shareholders just happy to take the healthy management fees every year from managing those hedge funds and delivering subpar returns to shareholders. So if I've got it straight, you could buy these shares at £10. Net asset value is, I think, 18. So £11 for the Brazilian ports business, and there's £7 per share of hedge funds in for free.
That's right.
So how does the discount compare? Because it's a 50% discount, but is that normal for this share, or is it particularly deep at the moment?
It's been quite deep over the last couple of years. If you look at the share price chart before the financial crisis, there was a big super cycle excitement with people getting excited about trade flows between China and Brazil. And actually, that wasn't just excitement. That was actually fundamentally what was going on, that the results improved a lot. So back then, the discount wasn't particularly big. And it did actually get up to, share price got up to about £16 per share about 10 years ago, I think. But since then, it's just the discoun's widened.
You talked about activist shareholders as well. There's City of London Investment Group, which is a small fund manager, which I own shares in. They popped up on the shareholder register late last year with a 5% stake. And they have been known as an activist. They buy investment trusts at discounts and take activist stance sometimes to close the discount through buybacks and other mechanisms. And so that's interesting because they're involved now. So I just wonder if they've had a word with the directors and said, look, try and sell Wilson Sons.
Okay, that's an interesting theory. I hadn't heard that and I hadn't noticed that. Yeah, then you get to sit into this discussion about how much power a 5% activist can have when there's a majority shareholding somewhere else.
Presumably this trust has been selling at a discount for years, and all of a sudden now they're trying to sell the crown jewel in the portfolio. So I think without this strategic review, this would be a value trap where you've just got entrenched management I think they're taking about $3 million a year in management fees. I think in your Money Week article, you said 90 hedge funds, which is very diverse. Yeah. They've not performed very well. I think they've even underperformed the FTSE 100 over the last few years. Not just the S&P, even the dinosaur index, the FTSE 100. And they're getting $3 million a year just for that.
They've probably changed their benchmark to the AIM market.
Funnily enough, the benchmark was to outperform inflation, which I think is...
Yes, that's racing ahead. Yeah. Have you considered Hansa Investment Trust? Because this owns a big stake in Ocean Wilson's, and you can get this sort of double discount because Hansa's on a 40% discount to NAV, which has a big stake in Ocean Wilson. So you get this double discount of buying a bit of Ocean and a 50% discount through Hansa, which is already trading at a 40% discount.
Funnily enough, when I wrote the article for Money Week, the editor of Money Week suggested that as the trade.
You'd be more exposed to these hedge funds because Hansa, I think it's 75% of these hedge funds and the other 25 is Ocean Wilson. I think the best asset along all this sort of complicated web of these trusts is the Brazilian ports business.
Yeah.
Don't think these hedge funds are always going to sell it at a discount. And I just don't have any confidence in the Salomon family, who are the big investors here. I think they're entrenched and outside shareholders are not getting suitable returns here. So I think if this business can sell the Brazilian ports business at a big premium to the current market value in Brazil, then yeah, you could get some upside here. It depends on what it can be sold for. If it ever gets sold, that's the thing.
Yeah, I also think there's limited downside as well in terms of the asymmetry if this doesn't come off.
I think the risk is, I think the downside is limited, but the risk is your money's tied up, nothing happens, and it becomes a value trap. You just get your dividend every year and nothing happens.
So I think there you could argue the deep value versus value trap case here, but I suppose for me, I like the idea of the income. The only asset I'd really want to own is the ports business. If that was sold, it would be maybe more of a special situation to hope to get some value out of it rather than something you'd keep holding with all those hedge funds. So Mark, has anything said here really changed your view, or is this not a kind of value situation you'd be looking for?
I tend to look at these pretty simply in terms of, I reckon you've got about sort of 25% downside if this doesn't go through, and also taking a bit of kind of share price weakness that you might get. I think it bottomed out in 2020 at just over £6-ish sort of thing. So I think in a bad case scenario, you could lose 25%, but equally you could gain 75% if they sell the whole lot and return it. So do I think there's more than a 33% chance that they're going to sell the lot? Not sure, to be honest. So I think potentially I'd put it a little bit higher. I'd put it maybe 45% chance that they actually realize the whole lot and therefore return the value. So statistically, I think there's a smaller sort of gain here. But if somebody, say Bruce, is more confident that there is going to be this realization, the case is then very strong. I'd want to do more work on what the incentives are, maybe even trying to go to an AGM or something like that and meet management and get a feel for what's actually happening. Maynard's laughing. Does this mean the AGM's in Brazil or something like that?
No, the AGM is in Bermuda.
Oh, yes.
At 9 o'clock in the morning, and for Hansa as well. So I get the impression they do not want to speak to ordinary investors.
So I take it you're not convinced, Maynard?
I can see why Bruce is interested. I can see the numbers look attractive on paper, at least. And the strategic review is important because without this would be a value trap. So let's hope something comes of selling Wilson Sons. I don't know if the company is fairly valued on the Brazilian Stock Exchange at the moment, or whether there's a trade buyer in the wings about to pay a healthy premium. I think what's also interesting is Hansa, because that has a controlling, or effectively a controlling stake in this Ocean Wilson's business. And its annual results after the strategic review said they talked about buying back shares and refusing to buy back shares in Hansa because it would raise the relative exposure to Brazil, which the board does not wish to do, giving preference to return generation potential and benefits of diversification generated by the investment portfolio. So if Hansa do not want to buy back shares, effectively buying Ocean Wilson shares, why should any of us? That's my concern. And the thing is, if this Brazilian business does not get sold, you're stuck with a handful of well-paid, underperforming fund managers based in Bermuda who do not want to talk to you.
So Bruce, are you still happy with your position, with the outlook?
I was actually just going to throw it back to the others and say, have they ever invested in a business where they felt that management weren't the sharpest tools in the box, but the fundamental business was attractive and eventually even people who are a bit dim figure it out?
Maynard?
I've had one or two of those shares in the past, although at the time of buying, I perhaps didn't think the management were dim. Now I've learned a few lessons. I tend to look for slightly smarter management, and management who look after outside shareholders is not convinced from looking at Ocean Wilson that management really give a monkeys, to be honest, about outside shareholders.
Mark, what about you?
I take the opposite view and I tend to not rate management at all because there's very little statistical evidence that management make much difference to a business. I think you're right that incentives matter. A hedge fund guy called Dan Rasmussen did a study on whether there was persistence of management skill between businesses. So when a manager moved from, or I think it was a CEO, moved from one business to the other, was there effectively a hot hand of management skill that carried over? And the answer was no. And the other thing he checked was, did management education, so did, for example, having an MBA or kind of business qualifications make any difference to the future performance of businesses? And again, the answer was no. I would happily take Bruce's undervaluation but terrible management, particularly because I think that usually great management get rated as great management because the share price has done well, and get rated as terrible management when the share price does badly. And usually great and terrible management are the same average management that run almost all businesses. But a controversial view, I know.
That almost sounds a bit like what people say about fund managers sometimes, is that there's a bit of a mean reversion tendency. Fund managers have a good run and they get highly rated, but it's not always sustainable over the long term. But I think having been affected by bad management once or twice, I've started to put more weighting on it than I have done, maybe than I would have done in the past when I'd been more focused on value. So it's one of those areas where there's a lot of intangibles and it's hard to be sure where the right balance is. But moving on, shall we take a look at Tristel? Maynard, I think this is a stock you've owned for quite a few years.
So I've owned this share for 9 years. I bought an average price of 46 pence back in 2013, 2014. Price now is £3.50. So the market cap is 165 million. Shares were over £6 the other year. So it's been a multi-bagger for me, with perhaps further to go. So it's a medical disinfection business. It makes wipes and foams that disinfect diagnostic medical devices. So if you go to the hospital, you've got a problem with your throat, let's say. Doctor might use an endoscope to look down your throat, and the scope has to be then disinfected before it's used on the next patient to prevent the spread of infection. So the moat here is this special chemistry. So the basic chemistry in these wipes and foams is chlorine dioxide, and which has been around for decades. But Tristel have enhanced the chemistry with some secret ingredients, which accelerate the chemical reaction to form a chlorine dioxide and improve what's called the biocidal efficiency, which kills all known germs dead or really quickly. So the products require approval from regulators, approval from the manufacturers of these medical devices. There's various patents and as well to cover the concept and design of these wipes and foams. So you look at the financial history, that's been masked by some legacy products which have fallen by the wayside. But the sales of these core wipes and foams, they're up about 4 to 5 times during my time as a shareholder to about £25 million. Adjusted profit, that's tripled to about £6 million. And there's high margins. There's a gross margin of 80%, adjusted operating margin of 20%, I think. Cash rich, no debt, no pension issues, no capex, no real working capital demands. So it's decent cash flow. I've had 3 special dividends during my time as a shareholder, plus useful ordinary dividends as well. And the sales growth target, this is the company's own target, is 10 to 15% growth a year for the next few years. And it's not just a UK business. 2/3 of these wipes and foams are sold overseas. So throughout Europe, Australia, China, Hong Kong, about 30 different countries. So the product travels really well. Now, these products are going to be sold in the United States. So this was announced last month. Companies got a FDA approval to sell a particular foam to disinfect ultrasound probes in the States. And the company said this was a milestone achievement that will allow us to significantly increase our global revenue. So what's the potential in the States? There's a company called Nanosonics, which makes a machine that disinfects ultrasound probes. And this is an Australian business. And last year it generated $80 million from this machine, disinfection machine. And it's got about 26,000 of these machines. And if you do some sums, based on the potential for 60,000 of these machines in the United States, the potential market for Tristel is $180 million a year, just from one particular foam. So the sales at the moment group sales at Tristel are about 30 million. So the potential could be that the United States could double the size of this business if it could take some market share from Nanosonics and Trofil. Plus, you've got the other non-US growth as well. So that sort of side of the business is growing at 10 to 15% a year. So a bit of wishful thinking, perhaps. But over the next 5-10 years, maybe by 2030, this business could be double or triple in size. The downside is that a lot of that growth is expected in the share price. That's effectively the bull case. I'll hand it back to the roundtable's verdict.
Maybe Mark, starting with you, I think this is more of a growth situation than a value one, looking at the share price. But what's your view on this business?
It's hard to ignore a company that has like an 80% gross margin. There's very few companies that manage to consistently keep that sort of gross margin. What's their IP here? Do they keep the other components secret, or have they patented them?
There's patents to protect patents cover the design, the broad concept of the products, of the design of the wipes and foams. The secret ingredients, the moat as such, is the secret ingredients going into the chemistry. And it's not just what these ingredients are, it's how much you put in and how these ingredients are manufactured. That makes the difference between how this chemistry works. Efficiency in a healthcare setting, because what counts is it works really quickly. So when the chemistry is mixed together without these what are called accelerants, it would take a long time for the chemistry to work properly, and which you don't want nurses hanging around waiting for these wipes or the chemistry to work. You've got to work as soon as you spray it onto a surface. It's got to work straight away. That's effectively most of the mode. Plus patents, plus the fact that if you wish to create a copy as such, it's all got to be regulated. And you've got to get approval from the device manufacturer. So if you manufacture these ultrasound probes, you're just not going to get approved, let's say, some sort of cheap Chinese knockoff copy. You want a proper approved disinfectant to be used on your device. So that stops hospitals buying cheaper copies.
Chemistry is chemistry. I think people could easily put this into some kind of scanner and work out what's in there. I agree on the side of the approval and the fact that they've got this regulatory moat. And so far, I don't see any evidence their moat is being eroded, but I do clock that their sort of average return on equity is only about sort of 15%. Now, some of that's weak years, and it wasn't as strong in the early years when their gross margin wasn't as high. But personally, I'd watch that closely, I think. In terms of historical growth, since about sort of 2015, when they had mature figures for the business, they've grown about 11% revenue and 11% net income, which suggests to me that there's not a lot of operational gearing. I'd watch that carefully. I'd want to see that the gross margin is amazing. Let's see that in the return on equity, and let's see that on eventually an operational leverage. It seems to me that they maybe are increasing costs and things like that at a rate now, and hopefully that will level off and then you'll get this operational gearing. But at 40 times, almost 40 times earnings, that to me looks like this is priced in. You're pricing in a big recovery on return on equity, keeping the gross margins and getting operational leverage in the future. And I struggle to say that's definitely the case. Now, I think if this was an P of 20, you could argue that, it favors betting on the fact that they can turn this around, can get these factors going with scale, particularly now they've got the US approval. But would I pay 40 for it? No, I think it's in the price at 40 personally.
I think on some of the historic numbers, there's been a lot of expense on the US regulatory project, which has generated no revenue. So that's affected the historic numbers, and they've written all that off. They've not adjusted that out. And there's also been all sorts of legacy products being culled as well. So the accounts of the last few years have not been straightforward. Plus, you've had pandemic disruption as well, where people have not been able to visit hospitals. So that's flatlined the revenue a little bit over the last few years. And you've got a lot of cash on the balance sheet, historically earning nothing. So that's affected ROE as well. I think if you look at the tangible assets, they're quite small compared to revenue and profit. And the working capital demands as well are pretty low. Stock is pretty low as well. So I think inherently it's a high return business. It's just some of the accounting and the just recent events have perhaps depressed the the sort of like headline numbers.
But surely that potential is in the forecast, the broker forecast.
Oh yeah, I'm not saying,
10% and 13% revenue growth.
Yeah, this is a longer term. I'm not saying I hold this. I bought years ago. It's 12 times earnings. So I'm not saying you should all pile in at 40 times earnings. But I think it would pay to hold on, at least for now. On the chemistry, your comment about anyone could reverse engineer the chemistry. That's exactly what I asked Bruce Green, who invented the chemistry. So this company hosts an open day every year in the HQ's car park in the summer every year. I spoke to Bruce Green and said, why can't other people just copy this chemistry, take these foams and just put it through the lab and see what's in it? And he said, it's just the way it's made. He said, it's almost impossible to reverse engineer. And people have tried, large American companies have tried, but failed. So presumably it could. But he said it's tried and no one's come up with a copy. And also, is it going to be worth their while as well? Because if you do, you think, okay, but it's going to be the company that could reverse engineer this is going to be a large business. So why would it bother getting involved in what is at the moment a relatively small business and profit? Is it going to be worth their while? Probably not. And they've been doing this for more than 20 years and no one's come along with any sort of similar wipe or foam. I've sat in company webinars, at least probably about 15, and every so often somebody asks, oh, what about the competition? They've batted away competition about somebody else coming in and with a similar sort of wipe or foam. The real competition is machines, this Trophon machine, where you put the device into the machine and it disinfects it automatically. The debate in hospitals is, do we buy a machine which costs a lot more, or do we go with these wipes which are cheaper, but there's a risk of human error where they don't wipe it completely? So that's the issue. The hospitals don't think, should I buy a different type of high-level disinfectant wipe? So that's the company's answer to the moat as such.
Bruce, do you have any thoughts on Tristel?
Yeah, I saw them present, I think 2015 or 16, when the share price was at £2. And I thought if it got a bit lower, I'd probably buy some, but I regretted not buying at 40p. But even back then, when they presented, that was the story, that they were going to get into the US market. And that is 6 or 7 years ago now. Do you know why it's taken them so long?
Yes. I bought the shares in 2013, 2014, and a year later, they started talking about entering the States. They said initially, we get a product up and running and sales starting in 2017, 2 years. So 8 years later, finally, they can sell these products in the States. So part of the problem is that management just totally underestimated the work involved. And also the FDA, apparently management say the FDA changed their sort of guidelines. So they talked to the FDA and they said, take this application route. This is the fast track route. And then a year or so into preparing the documentation for approval, the FDA came back and said, actually, no, take the full route. Now, there's a bit of an issue with how management communicated that change of mind from the FDA to shareholders. And if you look back through the RNSs, the FDA were telling Tristel one thing and Tristel were telling shareholders in the RNS something else for a few months. Didn't go down well. So, yeah, and plus the pandemic. So it's taken effectively 5 years, 5 years for the application to go through and 2 years of messing around, going the wrong way. So the board have not covered themselves in glory. I think if it had not got approved, then there'd be certainly management doubts as to whether the current management would be suitable to run this business, I think, having effectively promised to say they'll get approval in the States.
Yeah, just to add to that, at the presentation, this wasn't management who said this, is one of the questioners rather implied that the FDA were protectionist and were being deliberately awkward. Now, management were very tactful when they answered that. So that's not management's story, but a few investors seem to believe.
That question has always come up. Oh, is the FDA, all these delays due to the FDA wanting to promote some sort of American product? They approved Trophon, that's FDA approved. This is the Australian machine, which disinfects ultrasound probes. So they approved that okay. So yes, it was just a lot of management naivety, I think. They admitted that. But the admission came far too late, to be honest. And as I say, you look through the RNSs and they were telling shareholders one thing and the FDA were telling Tristel another. So yeah, the product's really good. I think the product's really good. Management, not so good, to be honest.
Were they selling shares during this period, though? Because looking back in the history, they seem to be just continuous sellers and exercising shares and selling. And they've bought back more recently, but only in kind of small amounts. So is there a risk that they're a little bit opportunistic in that way as well?
The chief executive finance director, I should say they're married. Not everybody knows that, but it's in the annual report. The chief executive has been selling shares. He was selling shares before I was buying. So he was a significant shareholder years ago, and he was selling at, I think, something like 40 pence. So a big chunk. His buys and sales have not really been a signal to buy and sell yourself. A lot of their shares have come from share options. So there's quite a generous, I would say a generous share options scheme, but they've done well out of share options. But the share options have been triggered on share price rises. When the share price was £2.75, they were issued share options, which vested if the price went to £3.50, £4.50 and £5. And so the share price did get to £5. And so they got all these share options, which was great. But the share price has gone back down to £3.50. But the management have got all these free shares. So
this Maynard sounds a lot like my argument. You can have a relatively poor management, but it doesn't matter if you've got a good product.
I'm careful what I'm saying here. I didn't really attend these company webinars. Sorry, the presentations. But management, I've made it clear on my blog, management haven't covered themselves in glory with US approval. But it's done now. It's in the bag. So that's... Yeah, but share options is another sort of touchy subject among shareholders.
Yeah, I suppose looking at it, obviously the US approval is good news finally, and there's a good product, and the business itself has some attractions. I suppose one thing I wonder about is that the FDA approval is obviously only the start of another new challenge with marketing and getting into distribution in the US, and also presumably they need to displace some kind of incumbent product that's already in use. So I wonder how easy or how hard that might be to gain a decent share of the US market when you've got to make a space for yourself in a new setting. I don't know if you've got any insight into that.
Yeah, the products are all going to be made by a partner in the States called Parker Labs. So Parker Labs are the leading manufacturer of ultrasound gel. So every time you have an ultrasound scan, you need to have gel on the probe because it helps the imaging on the sonographer so they can see what's actually happening on the screen. So it makes sense for Tristel to partner up with Parker because when you buy the gel, you can also buy the disinfectant as well for your ultrasound probe. So Parker will do all the manufacturing. They've got all the distribution as well. So they just package up this foam with the gel effectively. And it's, I think Tristel have said costs in the States would be £240,000 a year, which is less than what they're spent, which they have spent a year on the actual approval process. So the US operation should be low capex, high ROE effectively. They'll take a royalty from the sales. They'll take a 24% royalty from everything Parker sells in terms of their foams. So in terms of market share, the market is divided into three in the States. There's effectively Trophon, this machine, and then these old style acids, which you just dunk the device into, let's say, a bath of acid, which is very sort of antiquated way of disinfecting a medical device. Or you use some sort of non-approved wipe or cleaning fluid or whatever to clean these devices. So I think it coexists. Trophon, let's say, and Tristel coexist. Nanosonics is an Australian company. It's got Trophons all around Australia, and yet Australia is one of Tristel's biggest markets because they can coexist. Your machine may break down. Not every hospital can afford a machine. The machine has to be powered by the mains electricity. It has to be fixed in one room. Whereas your wipes, you can take them all around the hospital and disinfect your devices anywhere you want in the hospital. So there's plenty of scope to, say, coexist with Trophon and take market share from hospitals which effectively can't afford the Trophon and just using substandard disinfectants. Whereas now they'll get a cheaper alternative and they'll think, okay, this may be a better use. We can't afford the Trophon, but we could use these wipes instead. So I don't foresee any major problems gaining some market share here, especially with Parker. The whole US project is validated by Parker. They are a leading manufacturer of ultrasound gel. They've been around for years, and I think if they're involved, they can see the potential of these wipes selling, this foam selling really well in the States.
Coming back to you, Mark, then, can you see any circumstances when you might be tempted to buy Tristel? Is it the valuation or the business?
If the share price halves on this current metrics, I'd definitely be a buyer.
What about you, Bruce?
Same. It's just I'm put off by the valuation. And to be fair, I was put off by the valuation a few years ago, and it was £2 and it got all the way up to £6. Maybe that was the wrong decision.
So, Maynard, there's probably a fair amount of growth built in, but you're happy to sit tight in this situation and see what unfolds.
Yeah, for now. I've considered top slicing, but the trouble is I've started top slicing at 79 pence. It's always been wrong to top slice. And when I thought about top slicing at £6, I thought I better not top slice because every time I've top sliced, it's been wrong. Am I right to still hold on to this share? There's a question for the round table. Would you hold on?
I would, yes, but I wouldn't buy more, I don't think.
Yeah, I think I'd probably do the same, having come this far and understanding the business and the opportunity.
I'm not sure I would. If I'm not a buyer, then I'm also that's usually a sign that I should be a seller for me. That's the way I work.
Moving on, then, let's talk about the third share today, which is definitely more affordable. Arcontech. Mark, can you tell us a bit about Arcontech and why you think this is something you own? I understand.
Yeah, I'd start with what would you pay for a software company that is 100% recurring revenue, pretty much, and has a client list, which is Bank of England, JP Morgan, Goldman Sachs, Morgan Stanley, Barclays, BNP Paribas, Citibank, etc. It's basically all the big global banks, including the UK Central Bank, uses their software solutions and continues to pay their recurring license fees to use these solutions. And I think it would be potentially more than the current cash adjusted price earnings of 4 that this company trades on. I'm slightly picking my numbers here because the vast majority of this sort of the capitalization of this business is cash on the balance sheet. So enterprise is just less than 3 million with a market cap of 8.7. So this is a tiny business and a tiny market cap with all the attendant risks and issues that go with that. And it's not been doing particularly well. Its revenue's relatively kind of static over the last few years. EPS took a bit of a dive in 2022. It was consistently doing sort of 7 to 8p EPS and is now back around the kind of 5p level. And I go back and forth on the quality of the actual underlying software assets. What they do is they take a lot of financial data from different sources and allow users to combine that in their own way. And you can see how that is valuable for people. They can take data from Refinitiv, Bloomberg, FactSet, all the major kind of sources of data, and they have various different products they call from City Vision, which is a platform. I know what Bruce thinks about platform businesses and stuff that just does inserts into Excel. So on one level, this is real software that people use every day, and having worked in a big multinational firm, the firm runs on Excel. I used to create Excel documents that would do far more than multi-million-pound databases because users like to use Excel. It's simple, it's easy, they're used to it. I think there's value here, but I also think that their moat is potentially not particularly deep. Bloomberg, for example, could potentially come in and just produce products quite simply that cut these guys out of the loop, although that then limits a user to a particular source of data. And I think the part of the value here is taking the different types of data from different sources and enabling these banks to combine them and to report on using this data. I don't see this as a great growth stock. I know that they will look to accelerate their sales, which were sort of affected by COVID. But I also think there's quite a limited market for this sort of software. Their operating margin is almost 30%. Because it's software, almost all of these earnings just flow as cash flow. And you can see that the sort of net cash has been building up over the years. The big question is what they're going to do with that. They talk about acquisitions, but never seem to find anything or deliver. To me, this would be a sort of business that would be better off sold to somebody else, or at least returned a big chunk of this cash to shareholders. So it's not a business I love, although I think the nature of a recurring revenue software business is a very good type of business, but just looks too cheap to me. If you take that cash out, you're only paying 4 times earnings. Even if you assume they're not going to do anything with that cash apart from hold on to it, sit on the balance sheet and pay dividends, it's about a P of 12 and a dividend yield of 6%. Yeah, in summary, just looks too cheap at the moment. I wouldn't be a holder if it was 5 times the current price, but at the moment, this looks good value to me.
Maynard, what do you think about this business? I think the chief executive is one of the top 10 shareholders, if I've got that.
Yeah, but that doesn't persuade me, though. I looked at these in 2019. There was a well-known private investor, an ISA millionaire, who built up a 3 to 4% stake back then. And I thought, let's have a look at what he's seen in Arcontech. I didn't like it because I thought there was something wrong in the accounts. So the company had implemented IFRS 15 at the time, which is the revenue recognition for contract revenue recognition. And I thought it had implemented IFRS 15 wrong. It looked like it was booking revenue on day one for revenue that really should have been spread out, recognized over the term of the contract over the year. So I got in contact with the company, had an email back and forth with the FD, and the FD basically said, we've implemented IFRS 15 correctly. Have a read of the annual report. I thought they were aggressively recognizing revenue. Left it like that. And then, oh, look, a few months later, they came out with these results and they restated their revenue. It turns out they'd overstated their earnings by about 15%. So I've never looked at them since until now, because I just didn't trust the financial reporting of this company. I think the sloppy bookkeeping is still there. So I looked at the last half year results, and there's trade receivables now of 1.6 million, which is huge compared to the usual 300,000 or so in the books. And you've got half year sales of 1.4 million. So hold on, you've got receivables greater than sales. It just doesn't look right. And plus, if there's a weird movement as well with deferred income. Long story short, I think there's some items wrong on the balance sheet. I think the cash flow is fine. Everything adds up, but they've just got the balance sheet wrong with the trade receivables and the deferred income. It looks wrong to me, and it would not surprise me next year to see another restatement with the balance sheet. So I'm not convinced.
I think on one level that's a valid concern, but on another level, because the cash flow's coming in, it's less of a concern to me when they choose to recognize these things, particularly if they are long-term recurring revenue type business. And they do effectively balance themselves out, don't they? Or in fact, they are slightly more favorable in terms of the net amounts. So you see the deferred income's gone up by about 800k, but the trade and receivables has gone up by about 1.2 million. So and maybe some of that's gone into trade and other payables, but it doesn't make it. To me, that's accounting rules rather than whether they're actually going to get paid in cash for the software that they're delivering to customers.
I think the cash flow is fine. I think they've just reported wrong errors on the balance sheet, which doesn't give you much confidence in, are there other errors around? Who's actually checking these numbers before they get printed out to shareholders?
I was going to ask, has anyone seen management present?
No, they're very... Oh, sorry, Mark.
I don't believe so, no.
That was one of my issues. So I've bought this, and I bought this on the basis that they had a great margin and they were hiring salesmen, and then the pandemic hit. So I'm long and wrong. But then after the pandemic has been and gone, they've still failed to grow revenue, even though they've hired these salesmen. And I felt, I would have preferred to see management go out and tell a good story about how they can grow and what the size of their market is and who their competitors are and why they can't just be replaced by Bloomberg, or why JP Morgan can't just hire a couple of tech guys to build what they've built. And so it wasn't a particularly large position because I felt I wanted to actually hear the story from management. And I find it a bit odd that they haven't gone out and presented and got in front of investors.
I think there's an aspect they don't need the capital, do they? But when you're sitting on most of your market cap in cash, then you don't need money from the market. But that also questions why they listed. That a risk is potentially a management buyout here, where they could almost use the business's own cash and borrow against the recurring revenue and do
one
a
of
fairly
their
cheap
customers.
MBO. Yeah. They've got the contacts of people who are going to finance it, haven't they?
Oh no, maybe we shouldn't have suggested that. Oh, don't give them any ideas. The other thing that I did look at, though, is how it performed through the last financial crisis in 2008, 2009. And that was another reason why I bought it, was because the revenues actually grew at 19% when banks were firing all sorts of people in the front office, including me. And so I felt, this ought to be resilient and be able to grow even if there's a downturn. But they don't seem to have been able to grow through the pandemic. And they say that's because they couldn't have face-to-face meetings. And then after the pandemic, they don't seem to have been able to grow either.
Is that the fundamental problem, that nobody just wants this software? You've got 4 customers dominating the top line. It seems to be quite difficult to sell this software. And it seems to be bespoke work as well, rather than just an off-the-shelf package. Just seems like the competition here is just the IT department inside your customer. And if they need something doing, they'll go internally to the IT department rather than outsourcing it to Arcontech.
Yeah, I wonder if it's just too small a niche, maybe. One of the examples, for instance, on their website is a case study where they talked about developing a solution for a single team of 20 traders. So I'm sure, the value of business in that team was probably high. But if you look at a large organization like one of these big banks, that level of IT doesn't necessarily scale up. That kind of requirement, maybe it just doesn't have much scale potential to it for the business to expand. It's hard to tell from the outside, and without hearing management, you don't get that extra insight.
I have done some scuttlebutt here because I have a friend who works at the Bank of England. He's not on the Monetary Policy Committee, but he does work in the IT department. So I asked him about Arcontech, and he said he'd never heard of them, but he went and checked, and he confirmed that they did provide software to Bank of England. And he said the software was fine. It worked. They paid something every year, which is a bit disappointing, really, because I was hoping he was going to tell me something juicy, as if to say the software was fantastic or it's absolutely hopeless. But he said it was...
Or they don't use it, but somebody's left the billing on.
Yes. Yeah, he did say they only use 2 modules. There's about 9 modules they can use. They only use 2. It works. It's to do with, I think, auction results. So it takes auction results from banks, puts it into a data warehouse, and then distributes all the results out to all the other banks. So yeah, the scuttlebutt was that the software works. It is in the Bank of England. Yeah, that is something.
Maybe that's why they grew you the financial crisis, Bruce. They were doing a lot of LIBOR estimating.
Maynard, you're only going to be an interested observer on this business, are you?
I'm not sure. I am an observer, let's say. I'd be interested to see how the next set of accounts. I can understand why it's attractive because you've got a lot of cash sitting there doing nothing. The market cap's really small. There's a dividend. There's reliable revenue, assuming the 4 customers continue to pay. They have lost, I think, a large customer recently. They say it's 100% recurring revenue, but these customers can just say, I don't want to pay anymore. And is that recurring? I don't know. But the top line is dominated by 4 customers and a lot of bespoke work. It's not growing very fast, and management don't seem to be able to sell this product particularly well. The only saving grace, I think, was in a recent statement where they appointed a new non-exec, and they said in due course the company expects to review the composition of the board to further strengthen the company's markets and marketing strategy. So maybe you're going to get a salesperson in, a proper salesperson in to try and sell this product. But I just get the impression that the big banks just don't want the service. They can do it themselves. They can take these data feeds, knock at the UI internally rather than seek Arcontech's services.
What about you, Bruce? Are you planning to continue holding?
I am long and wrong. And I keep thinking, oh, I'll just give it another 6 months to see if they start making more sales. And it just feels like it's very hard to sell a stock when it's got a lot of cash and it's sitting there. It seems to me obviously cheap, but yeah, the share price hasn't gone anywhere for a couple of years. So maybe I'll change my mind and cut my losses at some point.
Mark, any final thoughts?
Yeah, just to reiterate, I don't think this is the highest quality stock. I have some doubts about it myself, but just the numbers look too cheap to me at the moment. And it wouldn't be a long-term hold for me if it re-rated to a more average rating.
To wrap up this episode, shall we talk a little bit more about portfolio management? I think in our last episode, we had a very interesting discussion about portfolio sizing. And as I recall, our personal portfolios ranged from 11 shares up to around 30. So quite a lot of variation there. And that's probably a useful reminder that there is never a single right answer in investing. What's right is what works for you and what you can stick with. And as a kind of following on from this, really, I think Mark, one of your followers on Twitter, asked if we could share our views on asset allocation as well. So I think the question here is whether we invest in other assets apart from UK shares, so perhaps property, bonds, crypto or gold, and how much of our portfolios we allocate to these other asset classes. If we start with you, Mark, what's your approach to asset allocation?
I only really invest in UK small cap shares, and theoretically, this is terrible asset allocation. Most of my returns on some level are very correlated. As you can tell, that UK markets in general and small caps even worse have not had a great period, and my short-term results will reflect this. But it's the area I feel I have the greatest competitive advantage in, particularly on the kind of psychological side of being willing to hold what everybody else hates. The reality for me is I see the theory of, oh, you have a certain percentage in bonds, you have a certain percentage in property into these different asset classes, but it really, all the theories are dependent on them being uncorrelated. And I just think that there's an old adage in the market, the only thing that goes up in a crisis is the correlation. And we've seen that these kind of supposedly uncorrelated diverse portfolios, pretty much this year, everything's gone down together. Bond yields have gone up, share prices have gone down. All the value in these sort of strategies is rebalancing between the different portfolios, or different asset classes. And I just don't have confidence that I could do this. Maybe if I want an easier, more relaxed life at some point in the future, I might follow a bit more of an asset allocation plan. I see value in being diversified, being uncorrelated. I just struggle to find truly uncorrelated assets that I want to invest in that will generate sufficient return to overcome the hopefully competitive advantage I have in UK small caps.
What about you, Bruce?
Just cash and shares. So in one sense, cash is how I diversify, protect myself from volatility because I sit on cash and then put it to work when the market tanks. I was going to mention, though, that I have just finished reading Mark Spitznagel's book, Safe Haven Investing, where he looks at these things like gold and government bonds and things that are supposed to be uncorrelated. And that's a very interesting read. And it's not financial orthodoxy, what he does, which is to buy alpha money options and construct trades with payoffs that are going to pay off when the market tanks like it did in March 2020. And he's also mates with Nassim Taleb, who advises on his hedge fund as well. So that's quite an interesting read if you're interested in portfolio allocation and portfolio theory, I'd suggest.
I think there's a bit of a theme coming here. I would say as well, cash and shares is really all I have. Shares because I think it's an area I have some understanding of. And unlike many of the other asset classes, historically shares have outperformed bonds and cash, for example. So on a long-term view, that's another attraction. In terms of cash too, I think the other reason I have quite a lot of cash generally is that having been self-employed for a long time, I've developed a mindset where I expect things may go wrong and want to be fairly self-sufficient. So I wouldn't want to have to try and sell even liquid assets that could be worth 20% less tomorrow, whereas drawing on cash technically might be inefficient in terms of returns, but it gives a good backstop and means that my investment progress isn't interrupted by short-term adverse events that might crop up from time to time. Maynard, are you an asset allocator or a shares guy?
I'm a shares guy, shares and cash guy. Basic rule I have is you invest in what you know. So if you're a shares guy, you invest in shares. If you like crypto, you stick to crypto. And it doesn't make sense to me to veer out from an area to something else just for diversification's sake. So yeah, it's just cash and shares. As simple as that, really. I understand, the Vanguard, these Vanguard 60-40 strategies and things like that, 80-20. I never understand why it's 60-40, who came up with that percentage and all these percentages, and is it just back testing that it's worked in the past? I don't think it worked last year because everything seems to fall last year. I think a lot of diversification is overrated, especially if you know something about the asset class. Definitely if you know something about the asset class that you favor. I think a lot of it's down to the media. They always talk about different asset classes. Maybe you should have a bit of gold because the media can then talk about something which is doing well. Oh, gold's doing well, so you should have a bit of gold in your portfolio. Oh, crypto's doing well. Oh, let's turn our attention to that. And your typical investor may be swayed by the media attention on particular asset classes, whereas really you should just be focusing on one particular asset class and becoming an expert there, whether it's shares or bonds or fine art or gold or whatever. You would get the best returns by focusing on that.
Yeah, I think it's easy to get bogged down in wondering if people talk about allocating their assets across several different sectors. You could easily spend time wondering whether you should have 10 or 15% of your assets in gold, or should you start a small crypto position in case it is the future. And you could spend so much time doing all of this. I agree. I think the time and the effort are better spent understanding one thing to a higher level, or else outsourcing it to someone else possibly. But a lot of the asset allocation story probably comes maybe from financial advisors and from the industry too. They're able to sell a broader range of products, tell a good story about diversification and a lack of correlation, but I don't think it really adds up for individual investors unless you've really got an incredible amount of bandwidth and knowledge and a broad range of analytical skills. It's certainly beyond me, I think.
It doesn't stay the same either. Gold worked well in the 1970s as a hedge, but a lot of hedge funds bought gold before the financial crisis because they thought that the banking system was going to collapse, so they'd buy gold. And actually the price of gold fell 27% in the second half of 2008. So just because something has worked before as a hedge doesn't mean that it's going to work in future.
It's interesting you've got this idea of the permanent portfolio, which I think is sort of 25% cash, 25% gold, 25% stocks and 25% bonds. Is that right? If I got the right things in there, but almost all the value is not the absolute returns, it's the ability to rebalance between these uncorrelated assets. And I just looked what the performance was for 2020, and it's, assuming this fund's numbers are correct, it's down 18%. So yeah, it's an interesting one, but I don't think asset allocation alone can remove the extreme downside risk that you face from being an investor. And it can be worse if you've developed an idea that any particular strategy is going to do that for you, because that's the time you're going to panic or change strategy or make irrational decisions. I think you have to be prepared that any strategy, even a theoretically good asset allocation one, can face extreme short-term negative results. And that's the price you're paying for being an investor. Even holding cash at the moment, you're losing money to inflation. Yeah, there's no magic bullet, unfortunately, for these things.
So I think a pretty unified view on cash and shares really across all of us.
I think it's overrated. I think asset allocation is overrated. A lot of nonsense talk. You mentioned financial advisors. It's just perhaps cover their backs. So you do okay as the client, but perhaps not as good as you could do. I think if you know something about a particular asset class, you should focus on that. Well, that's it for this time. Thanks for listening to the Investors Roundtable. If you enjoyed this episode, please do consider supporting our podcast through a monthly subscription. That way you'll keep the podcast going and help us remain free of full adverts. That website link again, pipod.co.uk. And if you join us before the 1st of August, you pay £10 a month instead of the normal £12.50. So until next time, thank you and goodbye.